Do you want to talk a little bit more to that slide, or you feel like you've shown it 3 times already?
I think everyone kind of gets it by now.
Okay, no worries. So I'll go straight to the question. You mentioned, I think in your first session, that regardless of the level of interest rates, growth investing can actually outperform. And it's the velocity of interest rates that matters. And what we went through in 2022, a period of time where interest rates rose quite dramatically, and that was bad for growth investing. My question to you is specifically within small caps.
Yep.
Doesn't the level of interest rate actually matter? Because when you think about those small companies, in order for them to grow, they're hungry for capital. The cost of capital, whether on the debt, on the equity side, will be higher if interest rates remain above 4% in Australia.
Yeah, and I guess that kind of comes to that qualitative overlay that you're placing on those companies you're investing in. Again, it's the same rigorous hurdle that we're looking at. We want these companies to effectively be cash flow positive on the operating line, so that you want them to have low levels of debt. You want to see that return on equity really powering. Like an ideal world metric for us is return on equity of 15 times or greater, averaging over 5 years. Sales growth of at least 6 times or greater over 5 years, and interest coverage on the EBIT line of 4 times or better. And so if you go back to first principles, that as a starting point, to your point, like it doesn't really matter where that absolute level of interest rates are. And you look back over since 2002 when we unitised the Small Companies Fund, we've got 8% alpha since inception. But even you look back over the last 5 years, we've had 8% alpha over 5 years, 8% alpha over the last 3 years, and I think it's 15% alpha last year. So even in rising rate environments, those attributes overlaid into that small company's profile can still produce some superior returns.
Okay, thank you, Jolon. We might switch to Eleanor. Eleanor, do you want to talk to us a little bit about the chart in front of us?
Well, Jonathan, I didn't see your slide. I've realised I've provided a very similar slide, but zoomed out a little bit further. So that's the performance of a $10,000 investment in 4 different asset classes on the ASX over the course of 20 years, unlike Jonathan's, which was, I think, 13 years. But I think the key point we're trying to make here is just that, whilst the ASX Small Ords has delivered investors 6% per annum, which is okay, the large cap index has delivered 9% per annum, pretty good. Really the standout here is the median active small cap manager, which has delivered investors 11% per annum over that 20-year period. It really is a fantastic asset class to get exposure to. We're getting a lot of clients asking us, is now the time? The small cap part of the market has underperformed the large cap part of the market by almost 20% over the last 2 years. We think it's very hard to time markets, but we do encourage our investors to look at that long-term track record. And if you're going to take a medium-term view, it really is a part of the market you do want exposure to.
Okay. Is there any particular stock you want to talk about within the portfolio?
A stock we've been talking about with our clients recently is a new addition to the portfolio. It's a company called Gentrack. It's currently a 3% active weight or a top 10 holding in the portfolio. And the reason we like Gentrack is it's going to benefit from the energy transition, not only in Australia, but globally. So they provide customer billing software to energy utility companies. As you can imagine, now that we've got wind and solar, we've got battery storage, customers pushing energy into the grid, that distribution model for energy utility companies is becoming a lot more complicated, and a technology provider like Gentrack, which is modern, flexible architecture, is going to take enormous market share from SAP and Oracle and help those companies transition their businesses and service their customers better. So we think Gentrack's a stock that everybody should have a look at, and hopefully it'll become a household name like a WiseTech or an Altium.
So more broadly, one of the things that I find very interesting about the Firetrail investment process is that you identify 5 large categories, 5 thematics of stocks, being companies that derive most of their earnings from Australia, globally, companies that are sensitive to essentially paying a yield, companies that are sensitive to interest rates, and resources company. Did I get that right?
Yes, that's all of them.
Within those 5 thematics, which you dynamically allocate between, in small caps, where do you currently find the most attractive opportunities?
Yeah, so just to elaborate slightly on that, if you're not familiar with Firetrail, the thematics is basically a way for us to reduce the macroeconomic risk in the fund. So for example, if we saw the Fed were to hike interest rates instead of cut interest rates, how is our portfolio likely to perform? And we want to really reduce that macroeconomic risk in the portfolio because we're not macroeconomists, we're bottom-up stock pickers, and we really want our stock selection to be driving the performance. So that's kind of the logic. We will occasionally have, under and overweights within those thematic risk buckets, and those overweights or underweights are driven by the bottom-up stock selection. So, Jonathan, as you kind of alluded to already, we are starting to see at the moment that the value part of the market is looking a little bit more interesting, in particular resources. I'm glad you said that you haven't given up on resources because we certainly haven't at Firetrail. My co-portfolio manager of the fund's actually an ex-mining engineer. We do really think you want that specialist expertise when it comes to picking stocks in the resource part of the market. It's probably the worst performing sector in the small cap market over the last 12 months. So we do think you want exposure to that looking forward. We've seen CapEx blowouts, cost blowouts, but now the commodity prices are starting to recover. And we think there's some really interesting opportunities there.
Thank you, Eleanor. David, from you, there's a particular company you want to talk to us about. Should I let you start?
Okay, so RPM Global is a mining software business. One of the benefits of small caps is you find all sorts of niche businesses across the economy. And this is a company that's been around for 20 years developing software for mining companies. So tier 1 miners, think BHP, Rio, Newmont, and this software is to help them manage all parts of their mining operations. So a lot of ERPs are built as a generic kind of manufacturing module. These guys have built software modules specifically for the task of mining. And they've spent about $200 million in R&D over the past 20 years building this software up. So it's not been a trivial exercise. And they're now starting to see real traction, and that's the revenue growth from the software that they're delivering to the clients, annual recurring revenue. And you can see it's not just the growth up until today that we're interested in or excited about with this stock, but it's the growth for the next, you can see here, 4 or 5 years on the chart, but it will go well beyond that. And what underpins that growth? Well, they're really early in that penetration story. Only 25% of tier 1 miners are currently customers of RPM Global. So they have a lot of new customers to get into. And like a lot of software companies, they have multiple modules to sell to their customers. But less than 7% of their customers today use more than one. So the land and expand strategy you might hear about with a lot of enterprise software players, these guys have that all in front of them. So it's a really interesting business that probably isn't very mainstream or well known.
Okay, so I've checked that company a little bit because I did get the slides ahead of time. And it seems to me on the data I was looking at that it's actually trading at quite expensive valuation. I think I saw around 50 times forward PE. And it also happens to me somewhat related to the resources sector, which is famously quite cyclical. Is that combination of cyclicality and high valuation not too dangerous?
I mean, that combination is a great reason why companies like this in small caps get overlooked, because people go, it's a mining service company on 50 times earnings, why would you look at it? RPM Global 3 years ago was on 100 times earnings, and it's doubled. The share price has doubled since then. So it's selling to companies that are cyclical. A lot of enterprise software companies sell to customers that are cyclical, but their business isn't. There's a recurring revenue stream coming out of their business. And the expectation, at least our expectation, is that growth will continue for a long time. So if you want a mining service business, if you want to misclassify RPM, for example, because of the sector it's in, you could buy McMahon's, which we also own, on 6 times earnings. And that has exactly those characteristics. It's more capital intensive, it's more exposed to the cycle, and you can see the difference in pricing that we think is appropriate between a high quality, low penetration growth software business and a capital heavy cyclical mining service business.
Thank you, David. Matt, so the company you want to talk to us about, if you allow me to introduce it a little bit.
Yeah, sure.
It seems to me like it's an old media, newspaper, radio company operating in a small market that's going through a recession. flat earnings over the last 3 years, top of its range in terms of valuation. Is that really your best idea, Matt?
Thanks for that, Jono. Look, if you don't know NZME, it's basically the Fairfax of New Zealand. And Fairfax 10 years ago was seen as a dead business. And what came out of Fairfax 10 years ago was Domain. And what we have in NZME is a division called OneRoof. And OneRoof is the second biggest property portal in New Zealand. That market has been slow to shift to digital. And so that number 2 position in that property portal market, we think, is going to play out in a big way for NZME. We've looked at Domain's revenues here in terms of their digital classifieds. Obviously, Domain is the second biggest player in the market behind REA. And we've adjusted for population and obviously for currency in New Zealand. And we think that OneRoof's revenue can easily double from here. And that's good revenue growth. That means digital revenue growth, and it's growing revenue. So NZME, we're not there for the paper business, we're not there for the audio business, we're actually there for the property portal. And we think there's exciting growth for that. If it does get to, say, 70 million of revenue in the next 3 to 5 years, and that would be more than doubling the current revenue base in that OneRoof business, and if you apply the same margin that Domain does here of 20%, you're talking about a business that's probably going to generate somewhere in that $14 to $15 million range. And Domain's on 20 times here, 20 times EBIT. So, OneRoof could be worth around $300 million. Currently, NZME is trading at around $200 million. So we think there's a great valuation story. We think there's a good growth story. And we think that OneRoof business has got some huge growth ahead of it.
Thank you. I think you've convinced me.
I hope so.
We have a little bit of time left, so I'll ask the same question and ask you to answer in turn. As Eleanor highlighted, small caps have gone through a particular long periods of underperformance versus large caps in Australia. Apart from pure belief in mean reversion, what would be your number one reason to go back into or to stick to small caps at the moment? Jolon?
We actually haven't had any underperformance, so it's been fairly unique over the last 5 years, even in a difficult environment. I guess small caps for us, it's a really great incubator where you can find the next leading businesses of the future, whether it's a realestate.com 20 years ago, a Xero, a WiseTech, a Pro Medicus, a Lavisa, or GYG that's just come to market today. So as we look forward, small caps plays an important part in our business and also in I'm sure your portfolios. And if you can identify these really high quality businesses that are the leaders of the future, and you have a disciplined approach to investing in them, it can be really, really valuable for the end investor. So that's why we really like small caps.
Thank you. Eleanor?
So we hate to kind of talk about timing markets because we certainly think that that's almost impossible to do. But the reason to think about small caps now is that they tend to run 6 to 9 months before we see the economy troughing. So we all know that it's pretty tough in Australia. Particularly the consumer's very weak still. But the minute we get a sign that the RBA is cutting or we have hit that trough level in the economy. It's already too late to wade into small cap equities. You really need to be there before the economy troughs. So that's one really good reason to start thinking about investing in small caps. The other reason we think is, as you would have seen Patrick's presentation on Guzman y Gomez earlier, it looks like capital events are returning to the Australian market, which at Firetrail we're very excited about that. We're managing 7 billion in Aussie equities, so we do get really great allocations from some of the big broking houses in Australia. And if we look back at the small cap funds performance, about 20% of our alpha generation has come from capital events. Now that's been missing from the fund, for largely 2 years now. Capital events dried up with that underperformance in the small cap market. Confidence was sucked out of the market. Instead, we saw private equity and corporates step into the market and take companies away from the index. But now we're actually starting to see signs that we're going to see IPOs, new companies listing. We've had Guzman y Gomez, Chemist Warehouse might be joining the exchange soon. And we're also starting to see a lot of companies get more optimistic and actually raise capital to go and pursue growth projects or even buy other businesses. So, we think that combination of hopefully the economy troughing soon and then also capital events coming back to Australia, really it's a good time to start thinking about Australian small caps.
Thank you, Eleanor. Matt?
Yeah, I think you've seen the market crowd into a small subset of names, a very narrow subset of names, and that's created a lot of return if you've owned those names. But outside of that, it's been very tough, obviously with interest rates going up, consumption falling, a lot of pressure on the economies. You've seen a huge devaluation outside of those crowded names, and at some point the interest rate environment will change, as Eleanor said, and you need to get ahead of that. And the valuation opportunity outside of those crowded trades, I think, is there's a huge opportunity outside of that, and small caps falls into that framework. So I'm pretty excited by the valuation opportunity. I think if you can take a 3 to 5 year view on small caps, you can make a lot of money from here.
Do you mean crowded names in large caps or in small caps? Sorry, can I ask a question?
Yeah,
Sure.
both.
Yeah,
both.
So, because I sort of agree with that there's a lot of narrowness at the top of the large cap market, and the same names are talked about again and again. Yet the structural reason why active managers in small caps tend to do well is it's just a really diverse, dynamic market with lots of opportunities. And so temporarily you may get markets that are a bit cheaper like they are now, but you've always got managers finding new businesses, new ideas, emerging growth stories, not having to decide between Telstra or CBA or BHP and be stuck in that kind of roundabout. And so that's why I think that structural outperformance and the opportunity will continue in smalls for a long time.
Well, thank you very much. Please join me in thanking David, Matt, Eleanor and Jolon.
Thank you.